Welcome everybody again to our second session in our financial planning seminar series. I'm Bob D'Amico. You guys got the email from me. And I'm glad you're here, and I'm glad that everyone out there on the World Wide Web is joining us as well. I work in the Advancement Office for Rutgers Business School, and what we've been trying to do is present more opportunities like we're doing tonight to provide service to our alumni and friends, and I hope you're getting a lot out of this. And it's now my pleasure to introduce Chris Lester, who is our presenter. Chris is a 25-year veteran in the financial planning industry and has a lot of great experience, and he's doing this for us, and we're very grateful for his expertise and the opportunity for you guys to learn from him. So with that, further ado is Chris.
Thank you. Good evening.
Good evening.
Good evening.
Let's try that again. Good evening.
Hi, Chris.
Good evening.
All right, I want to thank all of you for coming back for round two, and for those of you out there on the web, I want to welcome you. I understand there was a little bit of technical issues last week, so we're working through that. I think we should be a little bit better this time. I will have a little bit of a whiteboard. I understand that when I get to the point where I'm going to be talking on a whiteboard, they'll be able to switch your screen so that you can blow it up and see it a little bit clearer. Some of the information I'm going to share is going to be new to you, but some of it in the beginning is really just a recap of who I am and why I'm doing this. So we'll go through this. The first is the Prepare Institute. The Prepare Institute is a nationally recognized 501c3. It's a nonprofit, and they're very selective about advisors that they allow to present this information. The reason I'm here is that part of the Plan Giving division of Rutgers had come to one of the sessions I was conducting here at Rutgers, and they liked the content so much that they brought it back to the directors and the powers that be. The concept is, it's saying no audio, so can anybody else, if somebody wouldn't mind checking, can you hear me? Chief, I think you said that you could hear me. Just let me know if you have audio, because that might be a one-off no audio, and you might have to turn that on. So we'll double check before I go any further.
Yeah, I see no comments here.
No other comments? It says we're live, we're good. Keith, do we have audio? Because I have somebody monitoring as well. I just want to make sure that we don't go too far. Yeah, there's feedback though.
Yeah.
Okay, so I don't know the feedback, but I think everybody.
It could be a local problem.
Yeah, that's probably a local issue, so you might want to either dial in or reboot. So I'm good. Good. So we'll continue. So they're very selective about the advisors, but like I said, there was somebody, Matt Adams, who will be here presenting next week on estates and wills and trusts, and you know, as part of the board for the Plan Giving, when he came and sold this content, he said, you know, this would be really, really good for Rutgers staff and alumni. And so as he sat through it, and then Bob sat through the content, there's a great shortage of information on the retirement arena, and it's very complex, and everybody's rules are different. So one of the things I hold myself out as a comprehensive financial advisor, but one of the things I want to absolutely assure everybody, unlike most programs that you may have attended in the past, nothing's going to be sold here. So it's purely educational, right? We really are here to give back to the community, just like Rutgers has given back to the community. There will be an opportunity, and we're going to talk a little bit about this, of, you know, Rutgers is really, why are they doing this? And their hopes is if maybe if they can convey a sense of giving to you, that maybe in the future, there might be an opportunity for you to think of Rutgers in the future, right? They have done a great job to enhance this entire area, not only here, Newark, Camden, and they're continuing to expand. But that does take money. Now, we don't always have to part with money today. That could be something we do in the future. So keep that in mind, and that's where, really, I think where it can be win-win for everybody. My CYA, I'm not giving any tax or legal advice. And most of what I say up here today is audio yet. So, Susan, there is audio, so it's probably on your end, and we've double-checked that, so apologize. So we're not giving any legal advice. And again, a lot of the content, take back to your existing advisor. Double check with them. Find out if you hear something and you're not familiar with it or haven't heard it or haven't been shown, go back and say, hey, can I get some information on this? Because it really is, there's a lot of information out there. I think that covers that slide. So who am I? I'm going to give a little bit of, this is a different picture from last week, so I figured I'd mix it up a little bit, you know, a little stuff in the tie. I have some letters after my name. So I am a chartered financial consultant. That's a degree in the financial planning industry. I worked very hard for that, right? It's like a CPA in financial planning. As Bob said, I have over 25 years in financial planning. I've been doing this, and a lot of what I've done and what I've learned is by walking through the forest. I'm also a certified college planning specialist, so I help folks, you know, a lot of my clients, I've helped them to figure out and navigate how to pay for college without going broke, right? That's a rising cost, right? And then this here, this designation is, you know, I'm very proud of, but it's very unique. It's a retirement income certified planner. And what that means is it's not enough to get just to retirement, but we have to get through retirement. So a lot of the information I'm sharing with you here today is very, what I say, from cradle to the grave, helping you to understand where different aspects in your life will affect other areas of your life. So my experience, I grew up in Edison, New Jersey. I moved to Neshannock Station. I went into the Navy to be Navy SEAL. My uncle was Navy SEAL. I wanted to follow in his footsteps, and I went in, and my vision was bad. But I got a tremendous education, and my background is mechanical engineering. 25 years in the financial services industry. I'm a partner in a national training organization. You'll see, if you ever see a slide here, Eagle Team, that is not in the slides that we sent you today. These are bonus slides. They allow me to convey information, but it's separate and apart than what we handed out. But I am a national trainer. I train advisors. I was just telling Bob, we just got back from Minnesota, and you know, I was with some of the top advisors in the country, right? CPAs, CFPs. We all do brain banks, collective consciousness, right? Sharing of ideas. What are you doing? What's going on in your practice? What have you run up against? So it really allows me to stay sharp. Some of you may have heard of a radio station here in New Jersey 101.5. They used to do a Road to Financial Success. Some of the topics I've been preaching for 10 years, 15 years, since I've learned them. And then, been published in New Jersey Business Magazine. I'm married, I have 4 children, I have a grandchild, right? And then studied finances for over 25 years, designation. Fiduciary standard. Went over this last time, I'm going to go over it this time. And I'm going to show you these slides every time for the people that weren't here from the week before. So again, repetition. But here's a Reader's Digest version of what this means. By law, when you're dealing with an advisor, are they held to a suitability standard or are they held to a fiduciary standard? What that means is a fiduciary standard must by law put your interests ahead of their own. It's a very high bar. Most advisors that I've seen out there are only held to a suitability standard. It means they can offer you a product, and as long as it was not illegal, they can sell it to you. And really the difference to me is the disclosure factor. Here's what I've learned in my career. Nobody can invest for free. Nobody. And most people don't have a problem with buying something. What I find is most people have no idea what it costs. And it's okay, just understand it. As long as it's disclosed, that's just a good way to do business. And we're going to talk a little bit about that because there are some industries that go through painstaking efforts not to share information. And becoming a little less common. Have all of you heard about the 401ks and the disclosure of fees and everything must be disclosed? Yet I see quite often most people are not aware. All right, so why do I teach this course? I educate Americans so that the confiscation of wealth that happened to my mom and my grandparents do not happen to you. And I shared a little bit about that last time. I'm going to get into some detail this time. But bottom line is there through taxation and through the system, and when I talk about the system, I'm talking about the long-term care system, medical illnesses can devastate even the most well-laid retirement plans. So how do you get the most from this experience? Remembering your purpose. Each one of you in this room has different goals. What gets you out of bed every day? What puts skip in your step? What motivates you? This is, as we're talking about retirement, this is your retirement. If you like volunteering and helping out your fellow community members, whatever that is, then do it. But have that as part of your overall plan. Asking questions. Doing your homework. We're going to talk about homework. I gave homework. I think I sent out assignments. Did anybody get the homework attachment that I sent out last week? Yes, no? Yeah, I see. Good. And that homework sheet was designed. If you didn't get it, let me know. Send me an email. I'll get it to you. But it's designed for you to start a thought process. Start to collect the data. I can't tell you how many times I've had couples walk into my office and they go, "This was such a great exercise." It really helped us to start to collect things because we were sort of scattered. And that's what I'm here to do, is to help you to collect that data, whether it's with me or your existing advisor. My ninja skills, right? So make sure that you're going back and allowing your information to be presented back to you so that you understand it. And then participating in a lab session. We're not doing that as part of Rutgers because just by logistics, people in Camden or that are simulcasted, and we have people that are watching them from across the country, obviously can't get to my office. But you know what? Make it a point to get this information after you collect it. Get in front of somebody. Discuss it with somebody. Get some professional guidance. So why prepare? I was a Boy Scout. Talked about this last time. Proactive, retirement, education planning. And there's benefits. We got Hurricane Michael in Panhandle of Florida, right? Evacuating, when told to evacuate, is prudent. Listening to advice that is given to us in a timely fashion usually makes sense. So I asked this question, but I see a couple new faces in the audience today. So I'm going to ask this question. If you've been here before, heard it before, don't answer the question, but I do want audience participation. There are some hikers on our screen here, and there's a mountain on the page with a red flag. And the question is, if you were to guess, what is the goal of those hikers? Climb the mountain. Climb the mountain, right? Get to the top. Wouldn't you say that's a reasonable guess, young lady? Yeah. And I would agree. But I'd also say that that's half the goal. See, this is what the financial services industry and everything that you see in here would have you believe. This is all you need to worry about. Just collect enough money to get here, and you'll be fine. And what I share is that's only half the goal. You've got to get back down. Right? So when I talk about planning for retirement, it's not to age 62, 65, 67. It's to 95, 97, 100, 105. We have more centurions living in this country today than we've ever had in history. And it is estimated that that number by the 2050, I think we have about 57,000 centurions in the country. It's estimated by the year 2050, we will have 3.2 million centurions. We are living longer because of medical advancement and because we're paying attention to our health. So most of us can't envision, but would all of you agree? And I think I asked this question last time, but what was the oldest person that you know of? How old have they lived to? Shout out some answers.
95.
95.
105.
105.
102.
102. It's not uncommon anymore. That person used to be on the news. Now if they make it, I'm just telling you. So we all agree. So when we're planning, and I know we can't envision it, as human beings, we're usually dissuaded. Like, I'm never going to make it. I don't have that kind of gene. Right? So we talk about this, and that's what we're going to talk about today. I talk about with clients what could go wrong in retirement. Would you agree if we were going to climb that mountain? Could we fall? Could we get injured? Could we run out of food? Could the weather change? Could I freeze to death? Could an avalanche happen? All of those could happen. So retirement risks, we talk about running out of money, inflation, taxation, market risk, death of a spouse, injury or health decline, sequence of return. These two, the sequence of return and longevity risk are very big risks. But what we're going to talk about today, injury and health decline. Right? These are the ones that can wreck our plans. And we hear a lot of the other ones. But those are the ones where we go, oh my God, that guy is depressing. So we're going to talk about, we talked about last time, taxation and distribution planning. Today we're going to talk about risk management. This presentation today, last time I went, I bet you if I go to 7:45, will be a long time. I'm going to take us down a couple rabbit holes because I want to make some points. I want to give you guys value. I want you to teach us some things that I know. But at the end of the day, this is not going to be torture, I promise. And then we'll invite you back in 2 weeks. So what does retirement mean to you? Again, retirement planning, the establishment of a personal and financial goals to help you achieve your desired lifestyle. So we talked about this as well. Here are the common planning mistakes. Not defining how you wish to live your retirement. Not setting financial goals, not being educated about personal finance, not investing early in life or on a regular basis, not using tax laws to your advantage, not allocating and adjusting assets as needed, not planning for the unexpected, not being educated about employer benefits and retirement plan distributions, not planning your estate, and not creating a comprehensive financial plan. So these are mistakes, and we're here to enlighten you. So again, let's talk about how the retirement arena has changed. And again, for me personally, I call this, I think I talked about it last time, my grandparents, they used to call it mailbox money. They got pensions. They got Social Security checks. How did they live? They worked for the same company their whole life, right? Most of our parents and grandparents, you can probably name the company that they work for. Expected to retire. Once they retire, you put in your 25, 30 years, you got a pension. You're high-fiving each other, and you got to go watch. Right? Relied upon Social Security for supplemental income. We're expected to be focused on personal investments. They weren't required to really know that much. And that's what Bob and I were talking about before, is that, you know what, the rules have changed, but we were taught this stuff in high school. And that's because we had pensions. We had this ability. We knew that income, if I made it to the goal line, I would be good. Investments are paid for supplemental retirement needs. So that's how our parents' generation. Let's talk about how we live. The average person now has several different employers over their career. Now, I'm talking to Rutgers, but I would venture to say, just in this room, a lot of us have had several employers already in our life, right? The 401k has replaced the traditional pension. For a lot of you, it's the 403b. That's just another section of the code. Does basically the same thing. People need to independently pay for their retirement lifestyle. So once, you know, somebody gets to that flag at the top of the mountain, and they say, here's how I want to live, they're going to apply math, but they got to figure it out themselves, right? Social Security may cover very little, if any, of the lifestyle costs. We're going to talk about that. Some people will never fully retire, but choose to stay employed at some level. I'm going to go back to this one, because I just had a gentleman come into my office today, Social Security, and as I was going through the numbers, I said, is this Social Security number correct? He said, yeah, but they just started reducing it $134 a month because I just turned 65. That's because the cost of Medicare Part B, which we're going to talk about, he just hit the attained age. So they're going to reduce your Social Security. So retirement has changed, your planning process must change as well. So the new retirement planning strategies determine your desired lifestyle. This is your goals. This is your retirement. All I'm here is to listen to you and say, do I see any trouble ahead? Or your advisor. Educate yourself on retirement planning. That's why you're here, so good job. Establish your current financial status. I share this analogy. Has anybody here ever been to the mall? I just took my girls for the first time to the Menlo Park Mall, because we live down south, and we walked into a store, or we walked into the mall. I did not know where the store was. Where's the first place we go to? The directory. That's what you have to start with. Establishing your current financial status. You are here. Then everything from that point are assumptions. So, develop a plan, cover all possible scenarios, job loss, health problems, disability, changes to the Social Security benefits, they change the rules, implement the plan, acquire financial products to create the, we're going to talk about that, review and update your plan on a regular basis. Monitoring. This is Financial Planning 101 spelled out. So planning for today's retirement is successful retirement can be achieved if you educate yourselves. If we continue to grow, right? I do firmly believe in education. Even if we're done, I study every day. Something. On some topic. Right? I love to learn new stuff. I just joined a dive club in South Plainfield yesterday. I've been a scuba diver for a long time, but I didn't belong to a club. And I turned around and went down there. There was a lot of nice folks. It was over here. Anybody know where Spain is? This one over there. Good food. Right? And I turned, and it was great people. And I'm like, I got excited again because I love this stuff. So health and fitness, right? Leisure, recreation. So combining all this stuff so that you can live the life that you want to. Spirituality, giving back, staying connected, right? What's your purpose? Having a sense of purpose, right? We've all heard the story that we retire, I stopped working, and they were dead within 2 years. And we're scared to death. But you know how you prevent that? Have a purpose. Do something. Make your time on this planet worth it. And again, giving back to the community is absolutely the way to do that. Career and work, financial, home, relationships, community and charity. I talk about the health and fitness because I used to go to the gym, and I think I said this last time, a lot more than I do now because I'm swamped. But when I used to go there, I used to see a lot more of the retirees there. I'm going to get in shape now. But that's things that we can do. Let's start to have a sense of a routine. So this is the homework I gave out. If you didn't get it, send me an email. I'll get it to you. Take this to your advisor, but it's a good exercise to start to get into. So today's topic, risk management. Here's what we're going to discuss. Several risk management factors related to a successful retirement plan, including health insurance, the Affordable Health Care Act, Medicare, Medicaid, long-term care insurance, life insurance, living benefits, legacy, and wealth transfers. All right, fun. We're talking about insurance. I can tell you that when I go to a party, and if I'm on a plane, and I don't want to talk to the person next to me, they go, "What do you do for a living?" I sell insurance. People, you know why people have a hard time with insurance? It's because it's written by attorneys and designed by actuaries. And when you put those two words in the same sentence, they're complex products. And what I hope people try and understand, we get into this really and when I get into the investment section, but they're just tools. And I was talking about at the beginning of class, I have found in my career, people do not have an aversion to insurance. Absolutely do not. I can tell you the people that are in Florida right now wish to God somehow they had flood insurance. So the issue is, usually people don't have an aversion to insurance. What do they have an aversion to?
Time.
To disaster, right?
Premium.
Paying for it.
Paying for it.
Okay.
Let's be honest. If I could get free insurance, how much? I don't care what kind of. I don't care if it's homeowners. I don't care if it's health. I don't care if it's long-term care. I don't care if it's life. I don't care if it's disability. How much insurance would you sign up for if it was free? All I could get.
I will not.
You would not. Okay, you're one of the rare. There's always one.
Nothing is free.
Okay. But if it was in this perfect world, my point is people don't have an aversion to insurance. They just have an aversion for paying for it. So what I try and show people here is you gotta have balance, right? We don't need a life preserver this big, right? If we're in the middle of the ocean, I'll take one this big now. If I was in the middle of the ocean and the boat sank, give me a big old rubber raft. I'm perfectly okay. But if I got no chance of sinking on that ship, then I say, you know what, I could probably do without the rubber raft, carrying that around in my suitcase and luggage, right? All right. So we're going to go through this stuff. Questions you must be able to answer. How much financial risk are you willing to assume? Okay, car insurance is a good example, right? What level of insurance do you require, and what are the tools necessary to give you the coverage you need? So the importance of insurance, you usually accumulate the largest amount of assets just before retirement. Think about it. Anybody heard buy term insurance? and invest the difference, because when you get to retirement, you don't need life insurance. Anybody ever heard that? That used to be a common theme. There was a company back in the day called Primerica, and that's what they did. That was their claim to fame. Obviously, a large financial loss at a pivotal time in life could be devastating. Could you imagine if, so think about this. You own a home. One of your largest assets, let's say it's worth $300,000. You've paid your mortgage off. Would you ever consider not having fire protection or homeowners insurance? Because most of us could not afford a $300,000 loss if something happened. Even though not a one of you have probably had your house burned down, not only that, probably don't know anybody that had their house burned down. But we're not willing to take that risk. A comprehensive review of health and life insurance coverage should be considered mandatory for pre-retirees. We're entering into a whole new realm where typically health insurance is the one that can be expensive, and we don't know quite often what the true cost is, because quite often the employer is paying a portion of it. So what is the true cost? Insurance has the ability to shift financial risk from you to the insurance company. By protecting your assets with insurance, you're also giving yourself peace of mind. So let's talk about health insurance. Okay, before I get into Medicare, I am not, unless somebody wants me to, going to sit here and talk about traditional health insurance through your work, your employee, or that you can buy on the exchanges. Unless somebody goes, Chris, I don't understand. Do you understand what co-insurance is? My insurance company is, if it's 80-20, you take 20% of the liability insurance company. Does anybody understand what a copay is? We understand what a stop loss is, right? That's basic health insurance in a nutshell. You pay a premium, you have coverage, you get sick, the insurance company is going to pay a part, you're going to pay a part, and then you can mitigate the risk. That's health insurance at its core. I'm not going to spend a lot of time talking about that because at Rutgers or at your employer, if they're paying for a comprehensive plan, some type of coverage, you're paying a portion of the premium, and they're paying a portion of the premium, and then you share the risk on whatever the coverage, however the plan description dictates. So we know that. Where I find a lot of people do not understand Medicare. Raise your hand if you do not or understand Medicare. I'm the guy teaching the class. I do not sell Medicare. I've taken the Medicare courses. You can pick up Medicare. This is government-sponsored coverage. And the way that I explain this, and now if I'm on your screen and you have the ability to blow this up so that you can see the whiteboard, I would ask you to do so. So switch it, toggle it back, but all of you in the audience can see the whiteboard, correct? I want you to think of Medicare, right, as a wall. You have insurance costs back here, and Medicare is here to protect that from the consumer. But I want you to think of this wall has a bunch of holes in it. So this would just be like a dam. It's going to flood us if we don't take care of it. That is Medicare. There are two main parts to Medicare. Medicare Part A and Medicare Part B. Medicare Part A is hospitalization. The rules with Medicare Part A, but here's what you need to know. There is no cost to Medicare Part A to you because we've been paying into it for all these years. It's not free because technically we paid for it. The government is not charging for it, and I'm just going to throw a word out there. Yet. I don't know what the future means, but I'm saying up to this point, if you have Medicare Part A, there is no cost. You'll hear the word free thrown out there because we paid for it, and it's a benefit that the government gives us back should we utilize it. It's if you go into the hospital, you can be in there, and typically your stay is 110 days. Would you agree that you could spend $3,000 a day in a hospital? what this does is it will pay for a semi-private room up to 90 days, and then you get what they call reserve days, which are another 60. Bottom line is, could you envision a circumstance where you might be in the hospital for about 6 months? Could it happen? Could happen. That's what Medicare A is provided for, but if you make it to 6 months in a day, it could be a very expensive cost. So just understand it, and here's where it can get troubling, is that you must have exited the hospital and not been readmitted for 30 days, or now it counts as the same claim. Okay, so they got rules with this. Just know that there's no cost. Let's talk about Medicare Part B. This is doctor's visits. Has anybody gone to the doctor and they're seeing a sign in the doctor that says, we do not cover Medicare? If you go to the doctor, and the reason is because the doctor's not being paid by government. So understand that when you have Medicare plans and you want to go use it for doctor's visits, you might not be able to use your doctor, right? So there could be restrictions. Now, with this, I point out all these holes. There's a cost to it, $134 a month right now today. Medicare is means tested, meaning based on your income, now and in the future, they could charge you more, and that's just for a single. A lot of us are married. What do we got? $268, right? That we got to have now for cost. That's just to cover. That's on Social Security that's deducted immediately, and you've got to enroll for that at age 65. Now, at age 65, where's my, at age 65, you have 3 months prior to, 3 months after, and the month of. So you have a 7-month window to enroll for Medicare. And if you do so, you'll start to have your, now let's suppose you have not collected Social Security check. You get a bill and you have to pay the government. If you're still working and you have health insurance through your employer, that's what they call credible coverage. You don't need to take this, and there's no penalty should you not take it. But once you get off, retire from that employer, this is now going to come out of either your pocket or Social Security. Now, here's the gotcha. If you don't sign up for it and you don't have credible coverage, they start to charge you a penalty of 1% per month for every month you don't take it. So you might have a plan at work thinking that you have coverage. Rutgers is usually won't be an issue, but there are some smaller companies, and maybe the plan is non-compliant. And you could end up getting hit with a bill later on. So just understand, Medicare Part A is hospitalization. Medicare Part B is doctor's visits, and there's a cost. This is a bill that you will get handed to in retirement, and it usually is deducted immediately from your Social Security check. But if you haven't collected yet, you get to pay the bill. If you did collect, all of a sudden your check will be reduced. Does that make sense so far? Yes, sir.
So you're saying if you have credible coverage, the 134, you're employed and you got credible coverage, the 134 is not charged?
Correct.
Okay.
Don't pay it yet, but as soon as you retire, you're going to have to pick this up.
Okay, but it's not retroactive. It's from that point forward.
No, it's from that point forward. So it's grandfathered.
Anyway.
Pardon me? You still have to enroll. You have to go online and do it. Right? Medicare.gov. Okay. So that's these two things. Now let's talk about, has anybody ever heard of Medicare Part C? Oh, all these letters, the alphabet. So now you have Part C, and this is what you call Medicare Advantage. And what they're doing is they're going to help you to fill all these holes. They're going to come by and say, you know what, Mr. and Mrs. Consumer, we're going to help you put a plan in place, and guess what they tell you? When you walk into Costco or Walmart and the guy's sitting there selling Medicare Advantage plans, because that's what else they're called, what's he going to tell you? It's free. No cost. Just sign here. And again, there may not be any premium. Doesn't mean it's free. It doesn't mean that the rates can't change in the future. So Medicare Advantage plans, I'm typically not a fan of. Just in my experience, I don't sell these. I'm not in. I don't even do Medicare. I've done it for clients as a favor. Torture, right? Because it just absolutely is riddled with pitfalls and exceptions. If you did this, where your risk is with the deductibles and the stop losses. You could have, if you had a claim, I've seen some plans where you could have exposures of close to $10,000 to $15,000 of potential risk. So is that free? Like I said, so that's Medicare Part C.
But aren't there enough different versions of those that you go to the high end and
you could go down here and but understand, if we give something, we're giving up something. And what I've seen in my career, so I'll give you the example. We're about ready to talk about this with Medicare Part D. This includes usually Medicare Part D. So I heard my associate in my office told me that there was an attorney who told his mother not to get Medicare Part D. D stands for drugs. And she didn't. 2-3 years, there's a penalty for every year that you don't take Medicare Part D. And she ended up needing very expensive heart medicine. So it's doing $500 to $700 a month for that medicine, and you got no health insurance, can add up real quickly. So you have to start to weigh those options. So the Medicare supplement plans are Medicare Advantage plans. Again, we're dealing with insurance companies. So again, I'm going to use another example where I see these two words in the same sentence. I start to become suspicious. I have accountants making medical decisions with an insurance company in the same room. So understand, as a consumer, we need to understand what we've purchased. And usually the field advisors that are selling Medicare Advantage plans, it could be very inexpensive this year, but long term we could have some risk. That's all I'm saying. It's just a heads up, right? I just want you to be educated. And I'm going to show you now the alternative, which is where we hear this term, supplemental. Anybody ever heard this? So supplemental plans allow you to go out, and these are the Horizons of the world, the Humanas, and these different carriers. And they offer plans, again, to fill those holes. They're doing the same thing, but you get to pick the plan, and you get to pick the doctors, and you can do that. But here's where it gets, again, there's copay differences, there's co-insurance differences, and they start off something like this: A, B, C, D, F, L, whole bunch of letters here. Do you start to understand how this can get confusing? I just said this is Medicare Part A, and yet they got a plan called Supplemental Part A. So this is an area where a lot of seniors start to get into, and they're going, what did I just sell me? The best supplemental plan you can buy, fully comprehensive, will cover all the plans, is Plan F. Plan F, they've already talked about that they're taking off the market next year. Just telling you that right now, this is what I did it for my mom, this is what she's got. Okay? Now, that still does not include Part B. You still got to go out and buy a drug plan, and it depends on your needs, right? There's some inexpensive ones, maybe it's $30 a month, maybe it's $90 a month. Typically, when I'm planning for a couple to come into my office that is off COBRA and says, I want a budget for me and my wife, health insurance now into the future from age 65, what am I using as a number? And I'm using about, right now, $1,000 to $1,500 a month. And here's why. I lean towards the 1,500 because that's 18 grand a year. And let's say that it's only $12,000 this year. Because I know 10 years from now that it's going to be 18 grand. And I know 20 years from now it's going to be 24 grand. But I've funded it early. So I've pre-funded my healthcare needs. It is one of the biggest single risks is healthcare and long-term care. And most people forget it in retirement. They just haven't accounted for it because we have it paid for by our employer. We're not really thinking about it, and we get sticker shock. We're like, it costs how much? And then we go out and we buy the least expensive thing because it sounded good. I just say be cautious, okay? So that's my speech on, that's what all this set up here, and that's my explanation of it. Before I go any further, any questions thus far? Yes, sir.
So it sounds like one of the takeaways was it's advisable to enroll in Medicare Part B when you get 65 to avoid the penalty.
Yeah, but you don't even need to enroll into it yet. If you're still working,
Right.
you know, you can go on and enroll, but you don't have to pay for it. You know, if you're going to enroll, they're going to charge.
I thought you waived if you're employed.
It's not waived. You know, if you got credible coverage, you're not charging you the penalty. So you don't enroll. You only enroll in Part A
Okay.
because you have credible coverage.
Okay.
You don't need to pay the invoice right now for Part B until it comes to.
So A is mandatory to enroll, no?
Pardon me?
A is the one that is mandatory.
Yeah, I mean, it's almost automatically enrolled. You should go in there and do it and let them know and take it so you get your card in the mail.
And from there you go, depends on the situation.
Correct. Yes, ma'am.
So are there any, I guess if you have a Medicare Advantage plan or one of these supplemental plans, is there anything that would reduce your Part A coverage?
No. Well, no. It's
Where you have,
what is not reducing it, it's covering the holes. I always use the example of a colander. You know what a colander is? Right, when we're straining the spaghetti or cleaning lettuce or whatever. Think of Medicare A and B as a colander. And all a supplemental does is goes in and plugs all those holes. Now I'm going to be able to hold water. The question is will I have any risk if I take a Medicare Advantage plan? Or will I have any risk if I take a supplemental plan? The question is what is the potential to pay money out of pocket should a claim happen? And what is the likelihood? We're not actuaries, but the insurance companies, typically you got to think about who wants insurance? People that need it. Right? And if you need it, there could be hoops to jump through, or they're going to limit the amount that they're going to pay out, or it's going to cost you on the backside. I mean, insurance companies are going to figure out how it doesn't cost them money, right? They mitigate risk.
So the supplemental pays at 20% that Medicare doesn't pay.
Correct. In that example, right? So her statement was Medicare supplemental would pay the 20% that Medicare doesn't pay on the hospitalization or on the doctor's bills. Correct. It's filling up the calendars. It's paying what Medicare does not pay. When you take these insurance companies, if you did not have it, you're going to get a whole stack of medical bills. And what we're trying to do is not to have it. Now, your plan, and I've seen this, it's called utilization. If a client is not utilizing and doesn't need it and can get a supplemental plan, or I'm sorry, a Medicare Advantage plan at zero cost, sounds wonderful. And as long as we're not using it, I can absolutely say with a clear conscience, why wouldn't you do that? It's when we utilize it that we start to find out how lacking it is. And the only way for me to ever educate a client on it is to pull out the contract and start to show them. It's called the summary benefit description. They have to, by law, show you what the exposure is. What's the risk to the plan participant? And we just should know it. If you can mitigate that risk, if you're comfortable, you have enough assets to absorb that risk, then it's perfectly fine. Most people don't. Most people aren't aware of it. So they thought they had this plan that cost nothing. Then they went and had a claim, and it paid nothing. And they go, what happened? So I'm helping you to avoid some of those things. Just be aware. We good? Okay, continue on. Affordable Care Act. Again, this was, I'm not going to spend a lot of time here. because it was intended to improve access, insurance coverage, increase the quality of health insurance. The insurance industry, and one of the things I recognize, I've been in the health insurance arena here in New Jersey since 2000. And since the Florio administration, when they first created, they had 5 plans, A, B, C, D, right, and E. Those were the best plans. And you could buy them, and no medical underwriting, and everything was great. And what I started to watch in the industry was a systematic increase of premiums. Because the thought process is that a bunch of healthy pool of people would contribute to the plan and keep premiums low. And guess what happened? Nobody contributed. And it's called the death spiral. So when this rolled out, I knew it was just a matter of time. When you force, and you say, hey, listen, we're going to force everybody to buy insurance, usually what's going to happen is people are going to go, you can't force me to do anything. I'm not participating. I'm going to keep my money. I'm not sick. So who's left in the pool? Sick people. Causing a death spiral, right? So lower the insurance. The intentions were great. It's just we have a problem in this country. This can be debated from now until the next 3 administrations. But right now, this is what we have. So lower the uninsured rate, lower the average premium, insurance exchanges, mandates, and subsidies. Good luck dealing with these. My office has to call these folks. Good luck getting answers and responses to questions. It's a challenge, right? So again, I'm not going to spend a lot of time because that's the traditional health insurance arena. But once we get into the private sector of buying our own insurance, what are our options? And that's why I went into Medicare and Medicaid supplemental. Let's talk about long-term care. So has anybody here, and again, on call, whatever, had personal experience with somebody that needed long-term care? This is why I do what I do. I find that people that have had personal experience, our family or loved ones, are the people that get this. Now, there's been, since the year 2000, since I've been offering long-term care to clients, guess what I found out about long-term care? It's been mispriced. I did not understand the products back then, and I know that there are advisors that offer it today that don't understand the products. Because here's what happens. You need long-term care, Pat. It's Pat, right? You mind if I call you out? So, Pat, how old are you today? Oh, 56. 56. You need long-term care today? No, probably not. At 86, is it possible you need long-term care? Hopefully not, but possibly. Hopefully not, but possibly. And maybe if you're married, maybe your spouse might, right? So you think that, hey, listen, it sounds like a great idea, and we offer you a product today for you and your wife, a one-time bonus, $3,000 a month. Doesn't that sound wonderful? You go, you know what, I can afford it. That's prudent. I'm going to buy it. Guess what the insurance companies do between now and 86? Increase the premium. See, what most people don't understand about traditional long-term care, premiums are not guaranteed. I didn't know that when I first started. So all of a sudden, my mom, who I gave a very Cadillac policy with, calls me about once every 2 years. They raise my premiums again. What do we do? We have to start to cut benefits. I gave her a very rich policy, so we have the ability to do so. But that's what this industry has mispriced the risk. And the reason is because people are living longer and medical advancement. So think about it logically. If the insurance industry doesn't want to take this risk, how are you going to manage it? So what I find, I just look at, I see the writing on the wall. There used to be a dozen long-term care insurance companies in this country. There might be 2 now. John Hancock, who does federal employees, has left the individual market. Genworth, in 2016, took a $6 billion loss. Can insurance companies afford a $6 billion loss? I can tell you their board saying no. So if they're having these kinds of risks every year and they're dropping off and they're going, you know what? We can't afford this risk. What are you doing about it? What's your plan? And most folks don't have one. So you can we're going to go through this, but I just want you to understand, long-term care, it is stated today, I was just reading up on it, Fidelity just did a report, that you need, as a married couple entering into retirement, close to $300,000 set aside to cover healthcare costs and long-term care possible needs. Set aside just for that. Good luck. I'm not here to depress you. I'm just here to open your eyes. And this is what some of the pundits are saying. So, here's the other thing I've learned in my career. Nobody wants to go to a nursing home, and the question I have for everybody is why? Because they're depressing. What do we know about nursing homes? Honestly, if we were to be perfectly candid with everybody, where do people go to die? Where does elder abuse come in? That's why we don't want to go there. So where would most of our loved ones prefer to be taken care of? At home. So, you know, when you look at it, if you're going to have somebody come in and take care of your mom, your dad, somebody, it's either going to be a family member or you got to hire somebody. In today's dollars, you're at $34.27 a month. Let's just do some math on that. Roughly, you're at $40,000 a year. The average nursing home stay, 3 to 5 years. So we're coming up with an extra $200,000 to take care of that if they want to be taken. If you turn around and, right now I have a client just down in Lakewood who just passed away this year, let's say $80,000 a year. Some of the reports that I show and some of my calculators are saying it's $10,000 a month if you want to go into a nursing home. Crazy numbers. So people don't think about it because A, it's depressing. Who wants to sit around the dinner table and talk about it? You know what? And most of us don't want to be a burden on our kids, and they're working, right? They're doing something. They got families that they're raising. They didn't turn around and go, hey, you know what? And I had a client recently. I said, I know you said you're taking care of your mom. Where do your brother and sister live? Well, they other states. It's not like they can come help out. So did you know, according to the American Association for Long-Term Care, 904 days average. That's 3 years. Right? So will Medicare pay for long-term care? No. Medicare will only pay for skilled nursing. This is not considered skilled nursing. It's called activities of daily living. You can't eat. You can't bathe. You can't dress. Continence, right? Toileting, right? You can't do those things. 2 of them, you qualify for needing it. But the federal government is not going to help you to pay for it. If you can't be admitted into a hospital, you're not covered. So now somebody has to do that on a regular basis. And again, it was made clear to me when my grandmother, did I tell you the story about my grandfather who built the house last week? So I'm not going to torture you with that story. Okay, I don't want to be redundant, right? But again, when she went up here to North Branch and was in an assisted living facility, I watched my mom live in Reddington and was going back and forth every day, right? I wanted to help, but I'm working. I'm raising a family. So my mom had to give up everything she was doing to go watch my grandmother. Okay. Medicaid. So here's the thing. Medicaid, has anybody heard of spending down your assets below $2,000? So this is, this is a slippery slope. Because sometimes some of our parents have amassed wealth. And they want to give it to their children. Here's what I found in my career. Parents do not want to discuss their finances with their children. When they're 65, when they're 75, and right about 85, they go, all right, let's talk about it. But at 85, it's too late. Because in this state and federally, does anybody know what the look-back period is for assets?
5 years.
5 years. So just understand that they can go back in, and as long as you're trying to be creative, and we'll move this over here, we'll rename it and sell the house, and now the state's putting this out, and all of a sudden she becomes a ward of the state, they're going to throw out that net, and they're going to recoup that, because the government does not work for free. Okay? So keep that in mind. All right, so how will you pay for it, right? So pay for the cost yourself or ask a family member to help. You can purchase traditional long-term care insurance. We talked about that. That's expensive, right? Which is why most people have stopped doing this. Purchase an asset-based long-term care plan. What is that? And purchase life insurance combination policy. What are those? Great questions. So there are several possible benefits, right, to obtaining long-term care insurance. It provides more control and choice in the type and quality of care. You know, it's amazing if the funds have been set aside or you create a pool of money to help mom and dad out, that now decisions can be made that help their quality of life at that stage of their life. Less dependence on friends, family members. Right now, if you're working or whatever, I can't imagine the stress level when you still got to go to work and you're between paying your mortgage and going to help your mom or dad. Right? And then helps to protect your assets and preserve your financial legacy. Right? So is that something that can be accomplished? And so how? I mean, it might not be why you woke up this morning, but if there was a strategy to do so, would you do so? So option one, traditional long-term care. Both individuals are 60, standard health care rates. Each policy will give $164,000 based on a daily benefit of, you need $150 a day, and it'll pay for 3 years. So it creates a pool of money, right, for both mom and dad. Average cost $4,100. You go, you know what? I'm working, we're at high income earning periods of our life, we can afford that. What did I tell you? Are those rates guaranteed? Quiz time.
No.
Absolutely not. And most people find out too late. Or they haven't raised their rates recently. Be careful. So low cost 30, high cost 68. So again, it's a risk, but it is one way to do it. Asset-based long-term care insurance. Here's something that it's getting your head around it. I find that a lot of folks have money saved in the bank. CDs. You know why? Because they feel that it's safe. You got the FDIC limits. I can go down there and touch it. You know, Mrs. Jones can go down, sit down, and say, here's my passport savings, and can you show me my money? They just feel comfortable, right? It's a comfort level. What's the rate of return on that money? $100,000 in the bank right now? 4%, 0.5%, maybe if you're lucky, 1%. If you got a 5-year CD, maybe you found 2%. Okay? But what do you do? You could trade that asset with an insurance company. They will guarantee 180 to 100% of your money back to you, no ifs, ands, or buts, regardless. They'll give you a pool of money, this is, depending on whether we do it single or jointly, $451,000 for 6 years of coverage. Now, what's the average? 3. But you know what? To have averages means we have above the mean and below the mean. Maximum benefits of $6,200 a month, adult daycare, home health care assistance. Bottom line is there's an option, death benefit. So if you put in 100, it's going to leverage, but it's not going to get anybody rich. You know, 150. If you put money in $100,000 in a CD in the bank, and you have a bad day, and you got hit by, there's a lot of buses in New Jersey. You get hit by a bus. How much money is you getting from the CD? $100,000. At least this way, you traded the asset, the insurance company goes, you know what, your beneficiary gets $150. It leverages. So it's just trading pockets. That's how I explain it. And then, life insurance combination plan. This is another strategy. Some policies allow for the use of the death benefits to be used as the cash value for long-term need. And this section of the code, I told you, does anybody remember quiz time, what the most powerful section of the IRS code was that in my career that I found? Does anybody remember the number? Last week.
70 something, right?
7702, 72E, talk about DEFRA, and TAMRA. These are tax codes that have been around since the 80s that talk about the advantages of cash value life insurance. Okay. This is all under, so if anybody is feeling ambitious, you can go, this is all under the section of the code 101A of the Internal Revenue Code. 101A. Talks about all this stuff. It's not for the faint of heart. Good luck. But it's where you can go and double check and sort of get a grasp of the information. This section is under 101G. And it's the acceleration of a death benefit to be used for long-term care. So if I had $1 million death benefit, I could take 4 years, $240,000 a year to pay for long-term care needs, 3 or 4 years, as long as the money lasts, all tax-free. Just a different way to skin the cat. All I'm saying is that just understand that there are things out there that you can do to cover this risk. Does that make sense? Did I lose anybody?
Do you need any type of medical exam or something?
100%.
To qualify?
You got to pee in a cup. You get obtrusive medical questions. You get to pee in a cup and give blood.
Okay.
At what point, or do the premiums increase? So similar to the long-term insurance, like what is the?
So the way that these are typically designed, they can be funded over a period of time. So that's a conversation I typically save for a later day. I give homework. But understand, if somebody was 50, I could do a 20 pay, I could do a 10 pay, I could do a 5 pay. And what do I mean by that? The IRS allows, under these codes, for me to put excess money. So instead of, let's say that the cost of insurance for that year was $10,000. Let's just say overall for the first 10 years it was 10 grand. That was the actual cost for the $1 million death benefit, right? The IRS might say, you know what? You're allowed to do that, but we'll let you front load it and dump $250,000 of cash in there. And you put that there, you get a growth rate, it'll all pay the expenses, and you never have to put money in there again. And then, can it give you an income? These are conversations I'm about ready to have, but I just want you to, I don't want to get too far into these weeds. I just want you to understand that 101G is the acceleration of a death benefit to be used for long-term care. It does have to be paid for. So we can either go back typically to this plan where we have an asset, I call it non-performing asset, earning $100 grand or $100 grand earning next to nothing in this pocket, being taxed. I turn around and here's what happens. There's a term called a MEC, Modified Endowment Contracts. If you MEC a contract, they're not a bad thing. It just has to be done by design. The IRS will allow you to dump that money in, but all the growth and gains in that contract are subject to taxation. But normally, if you fund it correctly, like I told you, 5 years, 7 years, 10 years, 20 years, I can have all that gains grow tax-free. That's what we were talking about last week with taxation, how to do a super Roth. Cash value life insurance is a way to do that. I'm not talking about that today. I'm talking about the cash value life insurance to perform a function which is paying for the long-term care need. So all we did is we said we had a risk. We said, hey, listen, I probably need about $300,000 of coverage. If I took $100 grand and put it and gave it to an insurance company, there's 2 or 3 of them that do this, they will guarantee that if I never use it, I get all my money back. That's interesting. If I do use it, it'll create a pool of money that I can draw from for an extended period of time. That's the hybrid. Or I can go this route, which is I can say, I needed some life insurance anyway, or I not needed it, I wanted it because of some features that it offered. But you know what? If I needed it for long-term care, it's there. But if I needed it for tax-free income, it could be used for a different strategy as well. So anyway, any questions before I go any further? Because I know that this one, sometimes I get the deer in the headlight look. Yeah, insurance. I told you it's fun, right? All right, so life insurance. We're going to talk about why I'm usually not invited to dinner parties. That was a joke. We can laugh. Life insurance. And this when I converted it, but basically there's 4 types: term, whole life, universal life, and variable life. So we got term, we got whole life, we got universal life, and we got VULs. So most people, when they think of life insurance, What are some attributes that we think about with life insurance? Why do people have life insurance?
Sounds like they're only covered childcare costs.
Yeah, childcare costs, maybe the mortgage, maybe debt, maybe college, maybe the fund for retirement, right? So in your example, would you agree that most people view life insurance, you got to die to use it? That's why most people don't like life insurance. It's morbid. And they're not incorrect. But the insurance industry has improved the products and over the years. But I want you to understand term insurance, which is the cheapest insurance we can buy typically. We all know that, right? But most people don't truly understand how it works. And I always use the example of it is a flight of stairs. All insurance is a flight of stairs, and I'm going to put to age 100, and I am 50. Now, if you bought this when you were 30, and you bought a 20-year term, your premiums were level. But at age 50, they go to where they would have been. Your policy doesn't end. And I can open up a policy and show you right here, in year 21 or year 31 or whatever time frame you bought, the year after that term, the premiums escalated. So let's say we bought a 10-year term, and it was 60, and what they did is they averaged my premiums over that time frame. Now, would you agree that insurance companies have pretty big buildings in most major cities? There's a reason for it. And that's because 97 to 98% of term insurance policies never pay a claim. Think about that for a minute. 97 to 98% of term policies never pay a death benefit. And do you know why? Because most people drop them as soon as this happens. If you don't have catastrophic illness, you're going, I can't afford that anymore. Let it go. And the insurance companies have kept all that premium. So as a counter to that, there's something called whole life. Has anybody ever heard whole life? So, whole life is an industry, or life insurance is an industry. Whole life companies have been around since the 1800s. The first whole life insurance company was NILAC, 1846. And they eventually became New York Life. Okay? And they created policies that if you turned around and paid a premium, eventually it would endow and they would pay death benefit. What they did is they integrated a savings account inside of an insurance policy. But in essence, what we were doing is funding our own death benefit. So you agree that there was some cash value in that policy, right? It was your money, right? Savings account. So in the late 70s, early 80s, does anybody remember who the president was? Late 70s, early 80s? It's Jimmy Carter. And did we have some pretty high inflation rates back then?
Yes.
Okay. So 14, 16, we actually had a guy that had a CD that he was getting from a bank, Tennessee, 21%.
Wow.
So double digits were not uncommon, correct? What happened was there was a consumer advocate, the gentleman's name, anybody ever heard of Ralph Nader? Ralph Nader basically was asking of the insurance industry, we have banks and CDs paying 10, 12, 14, 16%. What is the rate of return on the cash value inside of a life insurance contract? And you know what the insurance company said to him? We don't have to tell you. Proprietary information, mum's the word. Huh. So the FTC did a 2-year investigation and found out that the internal rate of returns for most cash value life insurance back then was about 1 to 2%. 1 to 2%. And for CDs. So the New York Times, Daily News, I think actually, took out full-page ads and said, here, Mr. and Mrs. American, these insurance industries have been misleading you for years. Here's how you get them back. Go to your cash value life insurance, borrow the money out, because you can borrow that out. Rate of return of borrowing was 8%. Run on down to your bank and deposit it at 12%, and you will create an instant arbitrage overnight. And that's exactly what everybody did. And the insurance industry took it on the chin. They actually started to lose millions and billions of dollars. The insurance industry at that point in time was forced to create new products. I mean, here was their philosophy. Would you ever knowingly buy a product that you did not know the cost, know the fees, know the expenses? Would you ever buy it knowingly? Right? No, right? That doesn't make sense. That's what the insurance company asks you to do when you buy a whole life product. They do not disclose the cost anywhere in that contract. They won't tell you. Now, you can figure it out the next year after you purchased it. You can go back and figure out the internal rate of return and the cost, because then they have to declare it. But they're not going to lead with it. What they did, anybody remember a television commercial in the early 80s when E.F. Hutton speaks? People listen? That was the first company to create a product called the UL, Universal Life. Universal Life, what they did at that point in time, they lowered the mortality tables from the 1958 CSOs, which stands for Commissioner, Standard, and Ordinary Table, and they lowered it to the 1980 CSOs. Basically, people were living longer. They had unisex tables, and they were now making them male and female, smoker and non-smoker, preferred and standard, right? So when they did that and they lowered the cost, you can open up today any UL contract, anybody that's made it, and within the first 5 pages, I can see the cost, the loads, the fees, and the expenses. And we can make an informed decision. But here's the problem. Anybody remember Prudential had a class action lawsuit back in the 80s, 90s? What they were doing is they were running illustrations showing people 18% rate of return. And, oh, you only have to pay it for 7 years. You never have to pay a premium again. Guess how that turned out? Not so good. So, what I have seen in my career, most ULs, here's the difference. These costs in a whole life, and this is most guys that sell whole life contracts will tout. Our rates are guaranteed, guaranteed, guaranteed. Our costs, nothing, but you got to pay it forever. Guaranteed, guaranteed, guaranteed. This is their claim to fame, except dividends. Dividends in a whole life contract are not taxed, and they're not guaranteed. You go, wait a second, Mr. Lester, you just said dividends were not taxed in a whole life contract. How is that possible? Because just last class, didn't I say all income must pass through the tax filter? Didn't I say that? So why are dividends in a whole life contract not taxed? And the reason is the IRS did a ruling. And that ruling is they said, well, dividends in a participating contract are not really dividends in the commercial sense of the word. They're really a refund of the overcharge of premiums that we charge the consumer in the first place. They're giving you back your own money and going, aren't we great? That's why they're not guaranteed. So when you're talking to somebody about a whole life contract, hey, listen, if you got one, great. Just understand what you have. But this is not guaranteed. These are guaranteed. The rates and the costs and the fees and the premiums and the death benefits all guaranteed. Dividends, not guaranteed. But your rate, your crediting rate is not guaranteed. Therefore, your premium is suspect. So what do I mean there? And here's what I found in my career. Is when you buy an insurance product from here, they will lead in the first year and say, we're going to offer you 6% rate of return. And within 10 years, the board of directors at that insurance company will lower that to 4%. I've seen it happen over the last 15 years. Because that's not guaranteed. They can adjust it. And they need to answer to who? Stockholders, right? So understand that on the insurance companies. I like ULs. There's actually a product that I like. It depends. When I'm typically dealing with clients, it's called an index universal life. And the reason I like this is because I remove the insurance company from the equation. They don't care whether you make money. They're going to give you a zero. All they do is they buy a call option on an index. So we can remove them from the ability to play games, and it allows you. But here's the one that I think a lot of people, I have opinions. I'm going to give you my CYA. I'm not a fan of variable products. And I don't care if they're mortgages. I don't care if they're insurance. I don't care if they're annuities. Right? Variable products are typically misrepresented and expensive. So, has anybody ever gotten a prospectus from any financial institution? About that thick? 200 pages? When you buy a variable product, you will get a prospectus with it. My feelings are, when you need 200 pages to explain the cost of something, chances are it's too expensive. So that's a little bit about history of life insurance and some things. You know, they each have advantages. If you have something, don't give it up, because we're older. We may not be able to get insurance anymore. We might be uninsurable, right? Or it might be something where I say to somebody, if somebody goes, I don't need life insurance. I agree. Mathematically, I would agree with you. But I might show you why you want it if you're eligible. So we'll talk about that. So here's the thing, though, the living benefits. What can it do for me while I'm alive? I grow some money to grow tax-free, tax-deferred, like a super Roth IRA. I can provide some additional income that'll help me to reduce the taxation on my Social Security. I can maximize my pension income because, again, I'm lowering my tax calculation and pay for expenses of long-term care hospice. Just understand that there are tools. Life insurance is not the product that your grandparents had. It's changed, so you should understand it. So legacy considerations, and this is where I wanted to bring up Rutgers. You know, I can tell you I see clients on a regular basis, and just give this some consideration. First, everybody here has a homework assignment. Double check your beneficiaries on every single one of your accounts. I'm talking 401ks, 403bs, life insurance, and annuities. That's just prudent. There are two sections there. There's a primary beneficiary. Did I tell you the example of the client that I had that came in recently that turned around and sat in my office that was remarried? And she was not in the second meeting. We were moving some money. So we called the insurance company they were currently with, and they asked a challenge question. And that challenge question was, what is the name of the beneficiary on your account? And he said his current wife's name, and the one on the phone says, that is not accurate. His eyes went really big. It was his wife. Now, we fixed that. But I'm just letting you know it's important. But my point is that on beneficiary forms, a lot of times, how old are you, young man?
35.
35. How long? You work for Rutgers?
Yeah.
How long have you been here?
3 years.
3 years. So at 32, you filled out some paperwork.
Yeah.
Were you married then? Are you married now? Were you married then?
Yeah.
Okay. A lot of people come to work for a company. They got their mom listed. They got their mom. I know, but I'm saying they got their mom. They got like, listen, we're young, right? We didn't think about that, but we got to start to think about that now. That's primary beneficiary. But here's something I want to put a thought in mind. Listen, not everybody has kids. Not everybody's kids need a legacy. I see clients, they come in there, I'm going to brag about my kid. Look at what my kid's doing now. They don't need a nickel from me. I want you to give Rutgers a consideration on that contingent beneficiary line. Doesn't cost you nothing, and it can be a gift in the future. Right, you just put it down, you put Rutgers University, maybe even put a note there, Rutgers Business School. Because you know what we need here? We need a cafeteria. right? So I'm just thinking, you know what? Hey, it could be 5, 10 years from now, but you know what? It's a nice surprise that happens. And again, I believe in philanthropic giving. It's something. It's a strategy. If Rutgers, it's a way on your IRAs, with your 401ks, 403bs, TSPs, and/or life insurance annuities. Something you could do. Don't leave it blank. Because if you don't have somebody in your life, right, you turn around and now it's going to who? The state? Going to someone named? So look, give it this, the gift of giving, right? I like that. So, legacy, again, if this is important to you, great. You can read this. I'm not going to take us through every slide. This is not so much what I consider this, a charitable gift. And that's why I tried to get on the board with Matt Adams in the Planned Giving section, because when I was introduced to that, I was really impressed. I was like, you know what, I just see Rutgers growing and expanding. My office is here in Somerset, so again, I'm very fortunate to be a part of this and allow them to do this. So I just wanted to say, you asked me why I'm doing this, it's because I really do believe that Rutgers it can bring to the community. What if we can start to give a college tuition? I mean, it's growing, right? College, you pay for some of their expenses to somebody. So, option 4. This is the last one. This one can be painful. I can tell you, most people don't like to ask friends or family for help. You really don't. Like, I hope I don't get to that point, but you make an agreement with the kids or grandkids. You're like, hey, I paid for you and raised you your whole life. Make sure you take care of me. But really, what are we asking of them? Because taking care of somebody in their elder years, my mother and father-in-law live in Jim Thorpe. Her mother, they built that house. They sold her house and built on, and she's now 88. She'll tell you she's 92. I'm 92. No, you're not. But we are starting to, I mean, the thing that really resonates with me, and I'm seeing it firsthand now, they're in their retirement, and they can't go nowhere. They are tethered. They got to keep within a very close radius. So, again, it can be a very depressing arena, but I think with a little bit of planning, discussion, talk through it, make the best of whatever it is that you got and come up with some type of plan. We're at the end. I did pretty good. I did 90 minutes, so I said, 8:30, so I think I'm about on point. So, here's the key points to remember. We're going to come back in 2 weeks. 2 weeks, we're going to talk about estates, wills, trusts. You're not going to get to deal with me. We're going to bring Matt Adams up here. We're going to let him present to you on the will, on trust and all those topics. Bring all your legal questions, and please don't tell Matt I said this. I want you to challenge him. Let's test his knowledge. No, I'm just kidding. He is an attorney, and he's well versed. But he's a great guy and a great resource. And I figured let an attorney present that subject matter. But know your choices for long-term care. There are different options. Make sure your health insurance coverage and your health care needs now and into the future are covered. And then life insurance is more than just a death benefit. That was the message I was trying to convey, right? It's just that this is not your grandparents' insurance anymore. Action steps: be prepared, review your long-term care insurance, review your life insurance, review your Medicare and Medicaid supplemental insurance, and making sure you get all the benefits you desire. Now, we're about ready to wrap it up. I am going to open it up for questions, but because we're on a recorded line, as soon as, keep it general in nature, right, because of confidentiality. But before we do, let's have a warm round of applause for our speaker tonight, Chris Lester. So with that, do I have any questions? Because otherwise I'm going to turn the mic off.
Question about
Yes, sir.
the beneficiaries designation.
Yes.
For Sturkeys, where does that expand to? Direct lineage, or can I do it direct lineage for like a brother or a relative?
Great question. Table that till next week. I do know the answer. Give that to Matt.
Okay.
All right, that would be my advice. I do, like I said, I think, so the question was, is per Sturkeys versus per capita, how does that apply from a downline in transition? And my suggestion is since we're going to be talking about wills, trust powers, that's a perfect topic for next week. All right, good. All right, guys, thank you for coming in. Turn off the mics.